Hello, thank you everyone for attending this exclusive webinar, specially made for Dividend Week. Well, today, Josh and I, or mainly Josh, the dividend expert, is going to talk about dividend investing, build a dividend income machine, and how are we going to do this? Well, one dividend at a time. Next slide. Well, first things first, I would say. Well, disclaimer, I won't read everything here, but basically what this says is this is not investment advice. Please do your own homework. Well, we write and analyze companies that we generally believe in, but in the end, it's up to you to make the investment decision. So when we go to the next slide right now, you will probably see, the most important thing, who's compounding dividends. And I'm very honored that Josh, or better known as TJ Terwilliger, has joined compounding dividends here. He's a dividend expert, and I'll give the word to you here. Josh, can you tell a bit about yourself?
Yeah, sure. Like the slide says, I'm better known as TJ Terwilliger. That's generally what I go by. And I'm a self-taught investor. I'm really excited to talk to you about buying stocks, the same way we would buy a local business, and to go through kind of how to build an income machine that will continually pay you more and more on a regular basis. So how I got here, I'm still a partner of Compounding Quality. Um, had some interesting discussions in the community. Peter and I started talking. This idea for compounding dividends came up, and I've been writing on compounding dividends since August. And kind of why the idea came up? Well, because I think dividend investors just don't have a lot of great content right now. Most things just kind of focus on the yield and the payout ratio. I don't think that they analyze the business well enough. I think we need to look very closely at that. I think we need to look very closely at management. They're the ones that decide the capital allocation policies. They're the ones that decide how much we get paid. I think that gets skipped. And so I think it can be done a lot better than it currently is. And hopefully we're doing that. We've written the first investment case is out. The second one is either coming out quickly or will be just out, depending on when you're watching this webinar. But hopefully we're meeting that goal so far.
Perfect. So obviously people know that I'm more in the quality investing camp, so invest in the best companies in the world. But multiple roads that lead to Rome on the stock market. For example, when I look at my dad, he has quite some savings, and he doesn't want to be too influenced by the volatile Mr. Market and generate a consistent dividend income. So for him, for example, well, dividend investing might be really interesting. So what are we going to talk about today?
Yeah, so if you haven't read The Seven Habits of Highly Effective People by Stephen Covey, one of his points is that we should always start with the end in mind. So that's kind of what I want to do here. Let's think about why people invest. Most people are investing for something like retirement. Maybe they want financial freedom just to have the option to do whatever they want. Some people are investing in a college fund for young children. Some people might be investing to leave a legacy. You know, we can think about Warren Buffett. He just released his letter about how his funds are going to be distributed after his death. That's a lot of that at this point is about legacy. And if we think about what they have in common, you're investing to fund something. So you're going to spend the money eventually. So the point is to have some money, some income perhaps that you can spend, not necessarily just to rack up a great big number in an investment account somewhere. So with that in mind, we can kind of think about dividend investing as a way to maybe have some income and also build that investment account so that we have money we can do something with now and some funds for later for whatever reason that you might be investing for. I'm going to move on, Peter, and
Yes.
I'm going to kind of set the mindset a little bit more with a thought experiment. So I
Perfect.
want you to imagine you're in your living room. It's a Tuesday afternoon, Tuesday evening, and the lottery comes on. You don't usually buy a lottery ticket, but for some reason today you did, and they start calling the numbers. First number matches, so is your second one. You don't ever win anything. You're not a lucky person, so you're trying not to get too excited. But by the time they call the last number, you've won $10 million, let's say. Great. But that does create a problem. And that's what are you going to do with it? So you know that, spending it on whatever, a Ferrari and whatever you want is probably not the best plan. You don't just want to spend it down, but you're going to have expenses for the rest of your life. So the problem is, how are you going to invest it? And I've listed some things here. So, real estate's an option. That's nice. You get cash flow. Plus, if you buy the right properties in the right areas, hopefully those will become more valuable. You could do residential or you could do commercial. But either way, you've got to deal with tenants, you've got to deal with repairs. Um, Property management can help, but that's going to cut into your profits if you hire someone to manage your property for you. You can invest in a cash flowing business. You could buy something like, vending machines or a car wash. That's good. But you still have to run it or you have to hire a manager. And it's hard to find good help. To find someone that you trust to run these businesses, that's difficult. And if you decide that you want to sell it, these aren't things that are easy to sell for a high value. Maybe you could find a local business. Maybe your dentist wants to expand, and you could provide some funding in exchange for some equity in the business. But honestly, if you find one that's making a good cash flow, they can probably get debt. So it's either going to be hard to find this, or you're going to have to accept a lower return than the current interest rate that they can get. And you could invest in debt. That works now, but over a long term, it's probably not the best option to be the only thing. Interest rates are high right now, but that's due to inflation. And if we only stay in debt, that can be an issue in the long run. Your rate generally is going to stay fixed. And if inflation outpaces it, then you start losing purchasing power. So for all these, you're going to want a few of these in case something happens. You're going to want to put your eggs in multiple baskets. But again, the problem with a lot of these is they're hard to sell if you need your money back, and you have to be involved somehow. So we can look at a few other options.
Makes a lot of sense. So thanks for that. Would love to win the lottery one day. So
It's a good problem to have, isn't it?
exactly. So
So I thought maybe we could look at how the best investor in the world tackled this problem.
yeah, obviously it's a beautiful slide, Coca-Cola. I must confess, I'm a bit of an addict myself. So I drink one Coke, at least one Coke a day. And I think the amazing story today is Warren Buffett earns $25 in dividends just from Coke a second. So curious to learn more, Josh.
Yeah, yeah, I'm with you. I'm a Coke fan as well. Probably not one a day, but I've definitely contributed some of the funds that Buffett collects. So what Warren Buffett did was he bought a minority interest in Coca-Cola just through their common stock. He originally bought in 1988. The shares were still low from the 1987 crash, and Coca-Cola was still a bit disfavored when they tried to introduce a new Coke. Nobody liked it, and they had to go back, and that's why we have Coca-Cola Classic now. So we don't know exactly what he paid, but split adjusted, we do know that it closed that year at about $2.79 a share. So that's what I'm assuming was his cost basis for the rest of these calculations. But in 1989, Buffett would have got about 8 cents per share in dividends. So he got about a 2.8% yield, which doesn't sound that exciting. But what he did was hold on to the stock. And so for the next 36 years, Peter and I bought Coke, and the share price went up and the dividend payments went up. So the dividends and the share price both grew about 13% every year. So right now, Coke's around $70 a share, I think, and it's paying $2 a share in dividends. So if you look at this, Buffett paid $2.79 originally, and now he's getting almost that every year for every share in dividends. So that's how we get to the $25 a second. If we look at the per year, that's $750 million with a B dollars just in Coke dividends. And I think it's worth noting here that the growth in both the share price and the dividends went up together. It was about 13% for both. The revenue only grew about 5% per year over that forecast or over that time period, and the earnings grew about 7%. So we can see that the dividends drove a lot of the share price gains. So, like I said, now his original yield's over 70% on his original cost. So that's not a bad investment.
Absolutely. Yeah, I think is also the beautiful thing, TJ, is just to look at, and that's the beautiful thing about what you do about dividend growth investing, to look at the classical dividend yield, how everybody knows it, but look at the dividend yield based on your initial price, based on your purchase price. If you look here, well, the closing price 1988, 2.79 USD, and today there is a $2 dividend. So basically every day or every year, his dividend yield is almost 100%. And that's an amazing thing. And that's the beautiful thing about dividend growth investing.
Yeah, that's a great return. That's a great investment.
And obviously, next slide here, and I'm curious to learn, TJ, well, why dividend investing? Every investor is unique. Why is dividend investing something interesting? Why is it something for you?
Yes, I think if you're looking for some of that cash flow, dividend investing in public companies has a lot of things that some of those other options like real estate and buying a business don't have. So number one, it's really truly passive. You don't have to do anything other than monitor the business. You're going to want to keep an eye on it, make sure that nothing's changing, make sure that a competitor is not coming in and stealing market share, but you don't have to run the business day to day. Two, there's a lot of options. If you're looking for something like a vending machine route or a car wash, chances are you're going to want to buy something local so you can keep an eye on it and be involved. So that limits your options. There might be two car washes in your town or whatever. Here, we can pick almost any business in the world and have that as an option. Number three, they're highly liquid. Some of these private investments, if you get in and you need your money back or you find something more attractive that you want to get into, it's a long process to sell, and your number of potential buyers is limited. Most of these already have great management in place, so you get the best managers in the world to run them for you, and you really don't pay anything extra for it. And because we know that they're already winners, the income should continue to grow, just like Coca-Cola did for Warren Buffett. And also, the value of the company should continue to grow. So people sometimes look down on dividends because the payout's not that high when they start. They say, what's a 2.7 yield like Warren Buffett got on Coca-Cola? But we can see that eventually it grows, and that compounding is really hard for our brains to understand. But it becomes even more powerful if we reinvest the dividends. So those calculations for Warren Buffett assume that he did not reinvest any of the dividends. Had he continued to reinvest, he'd own even more Coca-Cola today. Those numbers would be even higher and even more impressive.
Beautiful, beautiful. And then we have the next one. Well, a building or machine. I suppose it's a dividend growth machine, a dividend income machine. So as Buffett said, well, you need to find a way to make money while you sleep, and if not, you will work until you die. So what's this money printer all about?
Yes, I like to imagine this as kind of a strange ATM machine that every once in a while it puts out some money. And if you put that money back in, the next time it'll spit out a little bit more. So if you keep doing that long enough, eventually it'll start putting out a lot of money. And that
Mhm.
sounds good. So I'm sure everybody wants to know how to build one. So here's kind of what we need to put one together. If you ever built something with Legos or an erector set, this is pretty similar. We need some parts. Those are going to be our companies that might be, stocks, it might be REITs, it might be master limited partnerships, but we need something that we can buy in the public markets that'll pay us some money. We need something to power it. We've already kind of touched on that. That's going to be compounding. That's going to be the engine that drives our machine. And then last, everyone gets the same parts, but not everyone wants to build the same thing. So we can customize this machine. We can tilt it towards more money to start or growing that money that it puts out faster. So we need some kind of plan. We need to know what we want to build ahead of time so that we end up with the right thing.
That's beautiful. And when you look at the entire dividend growth strategy, I guess there are multiple parts, multiple things. You already briefly touched upon that. Which parts should we look at?
Yeah. So I think there's a few different things we can look at. We will touch on that later, but some of the main ones are kind of there. So do you want future growth or do you want yield now? Are you looking at just the cash flow or are you looking at the value of the entire machine eventually? So you can build a machine that perhaps doesn't flow as much cash, but may see more appreciation of your capital. We can think about how frequently you want paid. Some companies pay a dividend once or twice a year. American companies, it's common to pay quarterly, but there are monthly paying companies, and there are ways to put together the same parts to make a machine that pays monthly, if that's something you need. So these are some of the important things to consider kind of before you start picking your parts and putting together your machine.
Perfect.
Yeah. So first thing, we can think about how to pick the right parts. If we're going to build a dividend income machine, we need good parts. So, kind of no matter what kind of machine you're building, there's probably three things we want. We need regular income. We would like that income to grow. We already talked about with the debt, we talked about inflation. So, we need our income to at least grow as fast as inflation if we want to maintain our purchasing power. And we want this machine to be reliable. We want it to run for a long time without a lot of maintenance. So if you don't recognize the car, that's an old Toyota Corolla. It's probably still running today. Whoever owns it probably puts gas in it, changes the tires and the brakes, and keeps driving it. They're incredibly reliable. And we know that machines that break down all the time aren't great. Think about McDonald's and their ice cream machines. They famously break all the time. They require a lot of maintenance. That's not what we're looking for. So to achieve this, there's two main things we need to think about. One, we need companies that are going to survive for a long time. And two, we need companies that are going to grow those earnings for a long time.
Great. Making sure our companies survive. So Lindy effect, well, a company that has been around for quite some time is way more likely to keep going on and keep performing well. So why is this so important regarding dividend investing and dividend growth investing?
Yeah, so if you think back to that Warren Buffett example with Coke, that took 36 years to get the income that he gets today. So we need a company that's going to be around for a long time to see the advantages of compounding. If that's what's powering our machine, we need something that's going to survive long enough to give us those effects. So this is really important. And Peter, like you said, the Lindy effect is something to consider here. You know, Coca-Cola, it's well over 100 years old. Those kind of companies, once they're that established, it's hard for someone to come along and take them out. So I think one of the best ways to think about finding things that are going to survive is to look at Charlie Munger's idea of inversion. Buffett called Munger the architect of Berkshire. His ideas shaped what Berkshire is today. One of my favorite ideas of his is inversion. So the easiest way I think to pick companies that will survive is to think about how we could kill a company.
Mhm.
So number one is debt. If we have a company that has a lot of debt and a lot of its cash flow is going back to repay that debt, that makes it fragile. So should there be a downturn, should there be a problem where the cash flow drops for a bit, bankruptcy is an option for that kind of company. We could pick a very competitive industry with low margins. That doesn't look great for survival. We could we could pay out too much of the income as dividends and not have enough to reinvest in the company, not spend on research and development, or growing into new markets. We could raise the dividend way faster than earnings, which would kind of put us in the boat of eventually paying out too much. We could put bad management in place. They could make bad decisions, bad capital allocation decisions, bad bad M&A is the last point there. If we get a company that tries to expand too much, buys the wrong company, that's a way a lot of companies get into trouble as well. And on the slide, there's three companies there that I think meet this criteria. We've already talked about Coca-Cola a little bit. Waste Management is a company that collects garbage. That's a company that probably is going to survive for a long time. There's always going to be garbage. People are always going to be willing to pay someone else to take the garbage away. Um, and that's a company with a great balance sheet. They do some M&A, but it's always a garbage collection company. So that's easy to integrate. They're not trying to go into different industries. They stick to what they do well. If you don't know Cintas, well, what they do is they provide uniforms, kind of entryway mats. If you think about those black runner mats that you see whenever you walk into a business, they do those. And they do cleaning supplies, things like paper towels, soap, and bathrooms. So if you hire Cintas for your business, they show up on a regular basis. They take your dirty uniforms away. They drop off clean ones. They drop off clean entryway mats. They take the dirty ones. They restock your supplies. They take that stuff back. They wash it. They clean it. And the next time they come, they just keep switching it out. So that's another company that need is always going to be there. They've grown slowly for a long time. There's a lot of room for them to grow. The management's great. The balance sheet's great. So these are the kind of companies that we want to think about when we think about companies that are going to be around for a long time.
Yeah, and the beautiful thing here also when you talk about waste management, when you talk about Cintas, to some degree also Coca-Cola, I would definitely consider Cintas as a quality company, probably also waste management, for example. So there is some kind of sweet spot where probably dividend investing meets quality investing. And it's really interesting to see these names here as well.
Yeah, I think a lot of that comes down to this survival piece. I think where it splits is kind of one, maybe the age of the company, how quickly they're still growing, how much market share there is left for them to take, and two, just kind of how management decides to allocate the capital. The companies that fall into the quality investing universe, management may be deciding to reinvest that capital more so. And some of these dividend companies may be deciding to pay more out. Some of that's going to be a function of the options that they have
Mhm.
to reinvest. Like I said, age of company, but there's definitely some overlap here between the quality universe and the dividend grower universe.
Exactly. Next one. What is also really important, obviously, in the long-term stock price as well, they always follow the evolution of the earnings growth. So I guess growth is also important for dividend investing, isn't it?
Yeah, absolutely. We already talked about we need those dividends to grow, whether we're looking for growth in the long term or whether we're living off those dividends now. We want growth at least to combat inflation. And this kind of goes to that Lindy effect that you talked about on the last slide, Peter. When we look at growth in the future, a lot of what we have to look at is growth in the past. And we want to look in a few different places. So we want to see revenue growth. If we're not growing that top line, it's hard to grow everything else in the long run. We want to make more sales over time. We like to see growth in earnings because we want to see those sales growth translated into profits. It's no good if we just keep lowering prices and we're selling more and more, but we're making the same amount or less in profits. And we want to see growth in dividends because we want to know that management is committed to returning some capital to us as shareholders, not just keeping it on the balance sheet or using it for M&A or whatever. This also, I think it's important to point out that this also shows that earnings growth does get converted into real cash. Earnings is an accounting number. It's an estimated amount of profits where dividends comes out of the actual cash flow of the business. And then finally, we'd like to see a growing market or some kind of tailwind. Um, if we go back to that other slide, with waste management, as population grows, there's going to be more and more trash to take care of. As people buy more and more stuff, there's more and more trash to take care of. So that's going to have a tailwind behind it. Coca-Cola tends to sell more Coca-Cola every year. That's got some growth and some tailwinds behind that. And Cintas, if we look at that company, they have a relatively low share of the market, and they can service almost any business that needs uniforms or entryway rugs or cleaning supplies or bathroom stocking. So more and more businesses are opened every year. So they've got tailwinds behind them as well. The example I chose on this slide, though, is ADP, it's automatic data processing. They do payroll and HR software, if you're not familiar. And again, this is one of those growing markets with secular tailwinds. Compliance is getting more complicated. People want paid digitally. Nobody wants a paper paycheck anymore. The employee portals are becoming more complex. Managing benefits for employees, it's all becoming more complicated. ADP takes care of all that. And if we look at this, we can see all those things in one slide. So we've got earnings growth, we've got revenue growth, and we've got the dividends all there. You can see a really nice upslope consistently every single year. It all grows. And if we look at the two line graphs, one is our earnings and one is our dividends, we can see that they're growing about the same rate. So this all looks very sustainable for ADP.
Great. We briefly, or you already talked about the dividend income machine. Well, obviously every investor is unique. How should we look about, for example, the dividend part versus the stock price appreciation? Do you want to have a dividend every quarter, every month? How do you look at that?
Yeah, so we can come back to that idea a little bit. One of the big considerations is our future growth versus our yield now. So if we're looking for yield now, I personally like to consider 4% or more. One way to think about this is to just compare it to kind of a short-term treasury bond or a short-term, very stable debt instrument. T-bills grow or treasury bills are a little bit higher than this at this point, but that'll get you kind of in the same ballpark. And then you still get the if you're going to hold for a few years, you still get the benefit of dividend growth and the growth of the value of the business. If we're looking at future growth, I still like to look for some kind of reasonable dividend yield. I like to look at something higher than the market. So currently the market's about 1.3%. I tend to target about 1.5 times that. So that gets us right around 2% ish. That chart on the right there kind of illustrates this interplay between growth and existing or starting yield. It's important to understand, and we'll talk about this a little bit more later. But you can see the line that's not growing so fast. That's a high yield, but not a lot of growth. And the other two lines are a higher starting yield, a little bit less growth, and an even lower starting yield, but more growth. You can see that they take about 17, 18, 19, 20 years to catch up. So if you're going to start with a lower yield, you need to realize either you need a longer time horizon or you need a lot of growth in that dividend. The other thing to consider here is that one of them is a 3% yield, one of them is 1.5. Your 3% yield is growing at 10%. To keep up with that, the 1.5% yield needs to grow at 14%, which is a relatively high growth rate.
Mhm.
We can also think about cash flow versus appreciation. So that's, are you only going to look at the cash that gets paid out in dividends? Or are you willing to look at kind of the growth of the entire thing, your dividends plus your share price? And that appreciation end tends to come from growth in the earnings, but also buybacks. So if management is allocating some capital towards buybacks, that tends to drive up those earnings per share, tends to drive up the share price. It also does tend to, if they're also paying a dividend, it will also drive up how much you receive in dividends because with every buyback, you own a little bit more of the company. So you get a little bit more of that cash flow that they're paying out in dividends. Last, we talked about payment frequency. Some companies do pay monthly, but if you want to kind of create that in your portfolio, there's four patterns or there's three typical patterns that are quarterly. So basically, if you buy one company that pays on each of those different schedules, you wind up with the dividend every month. You just need one company or several that pay starting in January, starting in February, and starting in March. And then as those dividends come in, you'll tend to get a check monthly.
Mm. That's the beautiful thing about investing today is that we can use some handy tools or stock screeners for to screen for attractive dividend growth stocks. Well, FinChat obviously is a great tool to use. So when listeners or people watching want to find great dividend stocks, well, which criteria should they use?
Yes, I put some example criteria in here, and this is not meant to be prescriptive. Hopefully, with some of those last slides, I gave you an understanding of kind of how some of these factors play together. And that's the biggest thing is understanding what you're looking for. And then you can start screening in different ways to find interesting companies. So if you want more growth, you can lower the starting yield and raise the dividend growth. If you want more yield, you might want to play with allowing a little bit more debt on the company. It's probably something more mature and something that flows a lot of cash and can handle that debt. There's different ways to think about this, but like you said, the beautiful thing is we can use a screener. Warren Buffett had to go to the library and page through the Moody's manuals and Value Line one page at a time. We can kind of go through everything in a few minutes. So with this screen, I kind of looked for a reasonable starting yield, some growth, and some low debt.
Yeah.
And you can see some of the examples that came up here. A lot of these companies are familiar. There are some REITs and things on there.
Mhm.
But I thought the next interesting thing to do might be to pick an example company out of this screen and just kind of go through it and how we would look at it.
Perfect. Looking curious to see. Oh, it's Watsco. Okay, perfect. And I don't think I ever told you this story, TJ. But last year in Alma, after the AGM of Berkshire Hathaway, after the AGM of Warren Buffett, I was at the YPO meeting and I met yeah, Tom Gaynor there from Markel, and he's also invested in Watsco. And once again, Watsco is probably an example of where quality meets dividend growth. In the sense that last year I was also looking at the company, I wrote a deep dive on it, and as Tom Gaynor was also invested in the company, well, I approached him and said, "Look, I wrote something about Watsco. Feel free to take a look, and if not, just throw the case away, and I will leave you alone." But he was really, really kind and really, yeah, really very open with his time. So we ended talking about Watsco for about 30 minutes. So Tom Gaynor thinks it's a beautiful business. I think too, and apparently you do so as well. So what is so interesting about Watsco, or what is the company doing?
Yeah, so this is one of the ones out of that screen that I thought was interesting. I didn't think it would be a very good example if I picked a company that we said in one slide or two, this is a terrible business that we would never buy it. So it's good to hear that you and Tom Gaynor agree with me that Watsco is a good business. If anyone's not familiar, what they do is they distribute HVAC equipment, mainly it's air conditioning and refrigeration. And this is from their investor presentation. It kind of shows their business model. They sit in that blue box in the middle. So if you have an air conditioning unit that's giving you trouble, that's broken, you call somebody to repair or replace it. That person comes out, that contractor decides what needs to be done, and then they're going to go buy the parts probably from Watsco. So Watsco services those contractors and installers. And then once that person has those parts, they're going to come back and install, repair, replace your air conditioner, whatever needs to be done. So the next thing I think that we need to look at, especially considering survival and growth, we want to know not just what the business does, but we want to know about the market that they're in. So Watsco is in a pretty good market, I think. It's hard to have a really great company in a bad market. So that top chart is the installed base of air conditioning units. And you can see that it goes up every single year. In the residential market, it's increased in size and it's increased in importance over the past several years for a few different reasons. So number one, all of those installed air conditioning units, they age. And eventually we know that they're going to run out of useful life. They're going to need replaced. There's been new higher efficiency models that regulatory mandates say that as new things come out, we need more energy efficient things installed, and consumers tend to prefer them. They're cheaper to run in the long run. So sometimes when things break, if it can be repaired, a lot of the time people will replace it with something more efficient. We're remodeling homes. Older homes might not have an air conditioner installed. When they get remodeled, a lot of the time one gets put in. We're putting in air conditioning in units that only had heating previously. And then last, more and more people are unwilling to live without air conditioning. So there's just a growing demand. And so looking at the market from both a survival and a growth standpoint, we can ask ourselves and think about, are people going to want to stop? Are they going to want to stop having air conditioning? Probably not. And since we know air conditioners last about 15, 16 years on average, we can kind of project the need and the demand forward based on the current installed base. So as that installed base continues to grow, there's going to be more and more service and more replacement parts and replacement of these units in the future. This is just another projection of the entire HVAC systems market. You can see it's projected to grow about 7.5, 7.4% as a whole. This is Watsco's net debt. It does fluctuate because they do acquire businesses fairly regularly. So when they acquire business, they tend to see an increase in their debt, but we can see they always pay it down quickly. And they're currently in a net cash position. So this is a good thing. And this already gives us a clue that they generate a lot of cash flow. They can pay down debt that quickly. That tells us that they're probably a profitable business that has a lot of cash flow coming in. So another piece on survival. This is dividend per share in blue. So we can see that continually goes up and up. And the dividend growth here kind of backs up the idea from the previous slide that they have a lot of cash flow. This is nice and steady. It's growing every year, and they're managing to pay down that debt all at the same time. The orange bars are the payout ratio, and this can look a little scary at first. In 2019, they paid out almost 100% in dividends. It's almost 79% in the trailing 12 months. So when we get here, we need to really dig in and say what's going on.
Yeah, and also here, let's just imagine on the previous slide that you bought Watsco in 2014. Dividend per share was $2, well, meaning let's say the dividend yield is 2%. Today the dividend is $10. So that's basically would be a 10% dividend yield on your initial price or your purchase price. And that's a really powerful concept that many people probably misunderstand.
Yeah, yeah, that's that compounding is really hard for our brains to wrap itself around how quickly things can grow over a medium to shorter long term or time horizon. So on the dividend payout ratio, when we dig into Watsco, what we find out is that they don't need a lot of capital to operate. This is the allocation of their operating cash flow over the past decade. Only 8% went to CapEx and 8% went to acquisitions. 21% went towards that debt pay down and 63% went to dividends. So when Watsco can invest in growing the business, it does very well. It's not putting a lot into CapEx and acquisitions. But over the past 5 years, Watsco's ROIC was over 20% on average. The thing with them is they just can't make those investments with those big payoffs that often. They need to wait for another distributor to be ready to be acquired, to do the due diligence. So they can't continuously do that. So when they can't, they tend to give the cash back to shareholders because they just don't need it. So now we can kind of start thinking about growth. Here's the top and bottom lines. So our earnings and our revenue for Watsco. Revenue, they've grown at almost 7% per year. If you remember that market slide, the projected growth of the market's about 7.5%. So this looks very sustainable. They're growing about the same rate as the market. And net income, they've grown at almost double that rate at about 13.5%. So that tells us that they're doing a good job running the business and converting those sales into actual profits and earnings that they can pay out to us as shareholders. So they put a slide together for us in their investor presentation materials that kind of shows us everything. You can see here that the net income and cash flow have both risen faster than dividends, which is a good thing for the sustainability of the dividend. They're all growing nicely. And then down towards the bottom there, you can see that CapEx and acquisitions have grown much slower. So we can see that even though Watsco has a high payout ratio, it looks sustainable. Again, they just don't need that much capital to run the business. In addition, we know that we got a market that should be stable. It should keep growing. In some ways, this is a really easy one because Watsco's generally replacing air conditioning units that are already installed. So we know when those air conditioners tend to wear out. We know how many are installed already. So that makes this piece pretty easy to calculate. It looks like a really good business to own. The only thing we haven't talked about yet is valuation. I did that on purpose because I tend not to do that until I decide that it's a business worth owning because I don't want to be influenced by something looking cheap. I still have a lot of the value investor roots in me, and I get very tempted by cheap looking businesses. Sometimes that works out well, sometimes not so much.
That's great. And also a beautiful thing is just to look at it from an owner's perspective, right? You can do the same on FinChat, basically turn on the owner's modus. And in that case, you don't see any valuation levels, you don't see the stock price, just the fundamentals of the business. And it's a beautiful way to think about investing. Just first think about the business and then the valuation second, and only buy great companies. So that's the first threshold. And then the second one, probably, yeah, we want to buy them at the price that makes sense.
Yeah, that's a great feature on FinChat as well. That's really powerful, and that kind of shows you how they think about investing. Probably the right way as the owner of the business, not as someone looking to trade the stock. So on Watsco's valuation, there's a lot of ways to look at valuation. I tend to use more than one, but one of the quickest screens that I kind of do is to look at the current dividend yield versus their history, and that's what this is. So dividend payers tend to work like bonds. As the price goes up, the yield's going to go down, and vice versa. So a high yield tells you that maybe the price is low. A lower yield tells you that the price is high. So we can see, even though Watsco passed our dividend yield test on the screen, it's yielding almost 2%, which is not bad for a grower like this. It's low compared to its history. So that gives us a clue that it might not be real cheap at this point. Another way to look at valuation is with an earnings growth model. So to do this, we need three things, basically. You can see we need the earnings per share growth, we need the dividend yield, and then we need a calculation on what's going to happen with the multiple. So we know the dividend yield. The earnings per share growth is fairly easy to guess at because Watsco and the industry are so stable. So we need the multiple. That's really the question. On the EPS growth, I went ahead and put some of the growth projections from FinChat right on the slide. We can see that the EPS growth is expected 9% per year, which, considering the industry, that seems reasonable. Watsco had been growing faster than that in the past, but that might not be reasonable to project all the way into the future. I tend to like to be conservative, so we'll take that 9% number. Looking at the multiple, this is the chart of their historic PE multiple. We can see that Watsco is trading at the highest PE in the last decade. So the question is, will the market continue to value them so highly? Maybe, but if we count on that, we're probably not leaving ourselves a lot of margin of safety. Looking at this chart, COVID in 2020 really seems to have swung Watsco's multiple all around. They've gone up, they've gone down, they're back up. But long term, it looks like the company tends to trade somewhere between 25 and 30 times earnings. So we probably need to consider some multiple contraction in there from the over 40 that it currently is. If we put it in the middle of that range at 27, that's going to be about a 4.5% headwind over the next 10 years. So we can fill in our formula. And when we do that, we see Watsco is a great company, but it looks maybe a little bit expensive. You can decide for yourself if this return fits what you need for your dividend income machine. You know, is a 2% yield now and a 6.5% total return per year acceptable to you, or would you like something higher? And if you want something higher, you know, going through this example, and if you went through this and did your research on this company, it's not a waste of time. You just can put this on your watch list, set yourself a price alert, and wait for the market to maybe offer up Watsco at a little more attractive valuation for you. You know, Mr. Market gets irrational from time to time, and it's very likely that at some point in the future, this business might go on sale.
Also here, TJ, you, Tom Gaynor, and I seem to agree. So beautiful business. Valuation looks a bit expensive, but as you mentioned, not a waste of time at all. Mr. Market will offer us opportunities, and one day the multiple will come down, and that's almost sure. And then you already did your homework, and you can take advantage of it if you think it's a reasonable opportunity.
Yeah, for sure. And if you're looking for, you know, if you're happy with a 2% dividend yield and you want something that's very, very stable in your portfolio, if that's more valuable to you than more growth in the future, you know, this could be a reasonable investment right now. But you know, running a screen like that, that's not the only place to find good parts for your dividend income machine. We can talk about some other places to kind of shop for some parts for your machine next.
Perfect. Sounds great. So dividend aristocrats, dividend kings. Well, interesting for those who never heard about it. What's a dividend aristocrat and what's the difference with a dividend king?
Yeah, so these are kind of pre-made lists um, that we can use as a starting point. The nice thing is these already exist. So the aristocrats are S&P 500 stocks. They have to have 25 years of consecutive dividend increases. And there are some market cap and liquidity requirements as well, kind of depending on who makes the list. That varies a little bit. And your dividend kings have 50 years of growth. These tend to be very large, very established companies. So the slide picture there is some of the dividend kings. I'm sure most people recognize a lot of these companies on here. There's Coke, you know, Johnson and Johnson, Procter and Gamble, 3M. GPC distributes auto parts in the US. That's Napa. If you know the Napa auto parts store, this is who distributes parts to those stores. But these aren't the only lists that we can look at. These are probably the most popular, but they're not the only ones that exist.
Oh,
So the champions are similar
go
to
ahead. I was about to ask
aristocrats.
what are some of the other lists, but you couldn't wait because you're so
Oh,
excited. So please go
I'm
on.
sorry, Peter. I'm too excited about it. That's right. Uh, I'm excited because honestly, I think these lists are maybe a little more interesting even than the first two. The champions are similar to the aristocrats. They need the 25 years of growth, but there's no other requirements. They don't have that you need to be included in the index. There's no market cap. There's no liquidity requirements. So you can find some small and mid cap companies in here that maybe some of the larger investment firms don't own. They're not in the index. So maybe a chance to find something a little more undervalued or something that the market's missing in here. And the dividend contenders, well, they need at least 10 years, but up to 24 years of dividend growth. And again, they're like the champions. There's no other requirements. We're just looking at companies that have grown their dividends consistently over a time period. Um, and if you're happy with 10 years of growth as a long enough track record, this is a great list. But also, you know, the difference between 23, 24 years and 25 years of dividend growth isn't that great. So this is a place where you can maybe find a few companies that are heading towards that dividend champion or dividend aristocrat level and haven't quite got there yet.
Great. So now we see the beautiful compounding at work once again. What's this all about?
Yeah, so I want to come back to this idea of customizing the machine. And the first thing wanted to point out is that until you have a good amount of capital in your account, you really have a lot of effect on how things go by your savings rate. So this was just a thought experiment I did. I got curious one day, and because I'm a nerd, I put it in a spreadsheet. So the question I had was, if you started with $25,000 and you could compound that at 15% a year, how long does it take me to do better than someone who puts $7,000 a year into an index fund? And the reason I picked those numbers, 7,000 is the current limit in the US for something like an IRA.
Mhm.
And this charts the answer. So the red line is the $7,000 a year. I compounded it at 8%. And the blue line is the 25,000 at 15%. And it takes 20 years for me to catch up, with the higher rate of return and never adding to my account. So after that, we know that the compounding is really going to take off and that line's really going to shoot up. But don't underestimate how hard 15% a year is for 20 years. The more money that you can put into that strange ATM machine that's putting more money back out at you, the faster that's going to grow and the better you're going to do. So number one, save what you can and invest what you can.
Beautiful, beautiful. So next one, yeah, future growth versus your yield now. Any specific insights there?
Yeah, so when we first talked about customizing the machine, the first point was this. We'll look at that chart again. And if we think about the one that I just showed you, this one looks a lot similar. It takes 18 or 20 years for the growth to really overtake the high starting yield. But once it does, it really just piles up. So the important point here is to really think about your time horizon. Do you have that 15, 18, 20 years before you really need those dividends? Or do you need to start with a higher starting yield now to get where you need to go? The other point that I want to make here is that you can mix and match your parts. So you can create a blended portfolio that has some companies with a moderate yield and good growth, some high yield companies in there that you're not only locked into buying high yield stocks or dividend growers. You can and you probably should own some of both. I think that's going to give you the best chance at getting the returns you want.
Next one, obviously, we talked mainly about dividend growth companies. Some people might also be interested in high dividend yield stocks, so stocks with a dividend yield of 5%, 6, 7, 8%. Are those interesting according to you?
Yeah, I think that they are, Peter. And this research comes from Hartford Funds. And what they did is they split dividend payers into five groups by yield. And the two highest yielding buckets outperform the market most often. You can see 70% of the time, the top two yielding buckets outperformed the market. So a lot of people are scared of yield. They think it equals risk, or that it's just old dying companies, or that the companies are cheap for a reason. And sometimes that's true, but sometimes it's not.
Okay, great. So that's also something we can see here. Indeed, for some people might think that high yield equals high risk, but that isn't the case.
No, this comes from the same research. And we can see that second bucket of high yielders that outperform the market at the same rate as the top bucket tends to pay out less than 50% of their earnings as dividends. And that doesn't equate to risky in my book. The top group that's paying out 75%, there's probably more risk there in the long run. But as we saw with Watsco, not necessarily. Watsco would fall into this category of paying somewhere 70-75% of their earnings as dividends, and I wouldn't call them risky. When you're paying out less than half, that definitely leaves a margin of safety, and that definitely leaves room to continue to grow that high dividend.
Cash flow versus appreciation. Once again, a beautiful slide. I see Black Tuesday on there, Black Monday. The current yield, 1.44%. How should we, yeah, look at this chart?
Yeah, so we know that having a higher starting yield is really helpful. But one problem with that is that the dividend yield of the overall market has been kind of trending downward. That's what this chart is. It's the dividend yield of the market. This looks maybe like it's bad. This looks like maybe it's going to be hard to find attractive yields in good companies. And this is one of the downsides of being a minority owner of a business. We talked about a lot of the good ones. Um, One of the downsides is we don't get to influence management and tell them, hey, we would like you to pay out a little bit more in dividends. We want some more of the cash flow. We own the business. But we're forced to invest in the market that we have, not necessarily the one that we want. But there's good news here too, and that's that this isn't the only way that management can return capital to us as shareholders. So thinking about this cash flow versus appreciation, if you're willing to open yourself up to some of those other ways, things can start to look a little more attractive. There's definitely attractive, high yielding companies that only pay out in dividends. But if you're willing to consider some of this appreciation, it is going to open up your investment options a bit.
Yeah, so probably indeed it's often overlooked buybacks, share buybacks, and indirectly that's also a form of dividends, right? And maybe it's even a bit more interesting than dividends from a fiscal perspective. So what's about all about the dividends versus share buybacks discussion?
Yeah. So share buybacks are the other way that management can return some capital to us. And this slide shows the dividend payouts in those green bars on the bottom. And then the buybacks are the purple bars on top there. And you can see that the use of buybacks has been going up faster than dividend payments. So if you're willing to consider more than just those dividend yields, again, you can find some really attractive opportunities. And as you said, it can be a bit of an indirect form of a dividend. Um, we talked earlier about that it drives up earnings per share and your slice of the dividends. I like to think about this like a pizza if you're not familiar with buybacks. So if you're sharing a pizza with a lot of people, everybody's going to get a small slice. But if someone decides they don't want their slice, you can divide that back up so that everyone has more pizza. And that's how a stock works. So when the company buys back the shares, that gets divided up amongst the shareholders and you own more. So that means that your shares should become more valuable, your dividend payments should grow, and if the company doesn't pay a dividend at all or pays a low dividend, because you own more of the company, if you need the cash, you can sell off that additional part that you've gained and turn it into cash. So it gives you the option. And the really, as you said, sometimes it's more interesting. One thing to consider is that buybacks are taxed at a lower rate than dividends. So you get to keep a little bit more of that cash flow that the company is returning to you in a buyback, and you get to decide if and when you sell off that additional interest to get the cash. So you're correct; they are definitely an interesting thing to consider.
Yeah, and your pizza story is making me hungry, and it's a coincidence probably, but that's also the first stock you bought, right? Domino's Pizza. It was a fun thing because you already knew that you were going to buy Domino's Pizza for a few weeks, I guess, and then Buffett
Yeah.
or Berkshire announced that they will buy or they that buy, bought Domino's Pizza as well. So it's great to see that you're fishing in the same pond as Warren Buffett, and that's some kind of approval for your investment case, right?
Yeah. It's always nice whenever a good investor agrees with you. It would have been nice. I was worried that it might shoot the share price up to where it was no longer attractive. Fortunately, that didn't happen. But I would have preferred maybe for that news to come out after we had bought and announced it. But we can't control the timing of those releases.
Exactly. That's a great story.
Yeah, maybe with your Dominoes, you should have a Coke as well, Peter.
Exactly. This is a slide we love to see as well, right? The S&P 500 since 1980, more or less. And then
Yeah,
we see that companies with a high, yeah, shareholder yield and so on, they perform really well. So obviously that means that you are fishing in a pond that is outperforming or seems to be outperforming, correct?
yeah, yep. That's exactly what this shows. So the higher dividend stocks do tend to outperform the market. But when we look at dividend payments plus buybacks, and a lot of places include debt pay down here as well, we get what's called shareholder yield. And what we see on this slide is that the companies that return the most capital overall to its shareholders tend to do even better than those high dividend yielders. And again, this isn't that you should go all in on dividend yields or buybacks, but I do think you should be willing to consider a mix of both in your portfolio. How you split it, again, it's going to depend on your goals, your time horizons, how much capital you're starting with, your needs. Um, I don't want to tell you what to build, but hopefully, I've given you a good starting place and an understanding of the different parts and kind of how they interact, so that you can create the income machine that you want.
Great. This has been amazing. So also learn a few things. So happy to have you on board. Well, when we wrap up everything, what's the conclusion about what's dividend investing all about according to you?
Yeah, I think if there's one thing to remember, it's this, and that's when we invest for dividends and shareholder yield, we're just buying businesses without thinking about what we'll be able to sell them for down the road, right? It's ownership. And that's the message that Ben Graham and Warren Buffett have been sending to us for years. We just look at buying a public company exactly the same way we'd look at buying a business down the street, like, a coffee shop or a car wash. We want something that's made money in the past. We want something that's likely to do well in the future. We don't want to run it, so we want good management in there. And then we want to pay a price that makes sense based on how much cash we can get out of this business. And in this strategy, that tends to be the dividends and the buybacks. So those are the parts of your income machine. Assemble a few of them, and they'll work together to grow you a stream of income that you can do whatever you want with. I think it's a simple, and I think it's a really beautiful strategy.
Beautiful. Thank you so much, TJ. Like I said, I'm feeling blessed that I have met you and to walk this journey with you and to have a dividend expert on the team. Because obviously also it makes more and more sense to, besides quality companies, for example, to have some great dividend growth companies in your portfolio, or even some companies with a high dividend yield or shareholder yield, obviously. So I would like to genuinely thank you. And also, I think, well, everyone who is listening right now or watching right now, well, if you have any questions for TJ, for me, we are always more than happy to answer them. Yeah, we are just, at least from my side, well, very happy to walk our investment journeys together. Any last words from your side, TJ?
Yeah, so hopefully, Peter, I gave a nice framework to think about building your portfolio. Hopefully, everyone learned something. I feel pretty happy and very fortunate to be involved as well. And to anybody that's watching, thank you for your time and thanks for being a partner. We appreciate you. And like Peter said, any questions, feel free to reach out.